Hi, Norman Hallett here with your next 4-minute drill for traders. Let's talk today about stop losses. Stop losses are your first line of defense for limiting losses. And it's safe to say that almost all traders are proponents of always using real stop losses and not just mental stops, where the stop is in your head and you don't actually place the order. There are many ideas about where to set stop loss targets. There are those who subscribe to a percentage of the profit as a target. For example, if your profit target is 6%, the stop loss would be set at 3% for a 2-to-1 ratio. Others prefer a 3-to-1 profit to loss target ratio. Many traders will look back over their typical holding time for a trade and look for the low if you're in a long position, and the low during the past time period the stop would be placed just below that low. Others consider the current volatility and set stops accordingly. But whatever system you choose, all stops should be actually placed, no matter what may come to pass. Gut feeling, false hope, and intuition should never, ever be part of your trading. Now, there are skeptics who are also arguing that by setting stops, you're vulnerable to having your stop run. All traders have had the experience of setting a stop loss, seeing the price retreat, activating the stop, and you're filled substantially lower than your stopping price. What might have been a profitable trade instead turns into a loss. It happens all the time, and some markets more than others, and particularly true with thinly traded markets. But skeptics of using real stop losses instead of mental ones are playing loose and dangerous, because it's the catastrophic loss that can put a large dent into your aggregate profits for a trader. Remember, trading is about a lot of small compounding profits, and a few large losses can really hurt. These blowout trade events must be guarded against at all costs. So what if you miss a big move now and then? It's the big losses that you need to avoid at all costs. It's okay to be a skeptic, but don't be a crazy skeptic. Use real stops. Also, there are times when a trader might want to widen stops. For example, if you decide to trade a high-risk, more volatile market, you may want to give yourself a little bit of breathing room. Recall that stops are often set 2-to-1, 3-to-1 ratio to your profit target. Now, usually high risk means high reward, so this should be reflected in where you set your stop. In other words, if you plan to trade high-risk markets, you should be compensated for that risk by the promise of a higher profit, which can also mean a larger stop between price and stop. So a larger distance there. So if you plan to trade in a highly volatile market, consider wider stops, but also wider profit margin targets. Higher volatility also should mean greater reward as well as risk. But have strict rules around the percentage of capital you're willing to risk for each trade. You should never exceed more than 3% of your equity on any trade, and preferably more like 1 or 2%. My last comment on stops is have a plan. Where you place your stop should be clearly defined as part of your trading plan. Okay, that's it for this edition of 4-Minute Drill for Traders. So until the next time, stay disciplined.